We're not AJO,
Okay,
we're using their spare labor. So
Exactly.
I'm
okay.
assuming, that might make an ass out of you. I mean, I'm pretty sure the Bay Area stats.
Well,
would
what
track
happens when
the
you
same
say,
way.
I presume? Then you make a...
Presume instead of assume?
Yeah. Welcome to the Best of Investing. I'm Edward Brown, your host. Here's our format. A bunch of guys sitting around a bar. There's no bar. Having drinks. There's no drinks either. But we're talking business, and you, the audience, are listening in. The Best of Investing is actually a radio show that has been around since August 2010, and it airs every Saturday on Fox News Radio, 9:10 a.m. at 1 p.m. Now, we're not a political show. We're strictly business, so everyone will be happy with that. Remember, I'm Edward Brown, wishing you the best of investing. Are you ready? Let's go. Welcome. You're listening to the Best of Investing on Fox News Radio, 9:10 a.m. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. For those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks without the drinks, talking business with you, the audience, listening in. I'm your host, Edward Brown, and today we have another special guest who we've had in the studio before, Mike Zaidlin, a registered investment advisor. But introduce yourself a little bit more about what you're going to talk about today.
Sure, Edward. Thanks for having me back. My name is Mike Zaidlin. I work here in San Rafael, and I am a wealth manager, which basically means I provide financial planning, investment advice, and estate planning for individuals and small businesses.
So, Mike, today we're going to talk a little bit about retirement accounts, I understand.
That's a great subject. Almost everyone's, or most people have one, or will potentially inherit one, or consider having one.
You know, I want to retire.
Don't we all?
And this time of year, of course, we've got, it's Christmas Eve, and we've got maybe a little bit less than a week to do our year-end tax planning. It's usually about when I start, so, although I guess when it comes to retirement accounts, in order to do some tax planning that might impact 2011, I understand we have a little bit longer than December 31st to make some planning decisions. Is that true?
That's right, Mark. You have until April 15th to make a contribution to your IRA or Roth IRA or SEP, simple IRA, for the 2011 tax year.
Awesome. So what should people know when they're deciding who to leave their retirement benefits to?
Well, that's a big question.
Just leave it to me.
Yeah. We're available.
Well, obviously, the decision as to who to leave money to or any assets to is complicated and very personal. And what I try to do is always make sure that my clients understand simply the implications of choosing who they've chosen to do that for, or using that information to make another decision. But information is always helpful, education is always good, and so what I'd like to do here is just provide some of that, so that can be of some help to people to consider things they may not have thought of before. The greatest benefit for passing on retirement assets, whether that's a work plan, a retirement plan, such as a defined benefit pension plan, a 401k, or a traditional IRA or a Roth IRA, the greatest benefits are usually achieved by leaving it to a spouse. And the reason for that is the spouse is the only person who can roll over into his or her own IRA the inherited account that she receives or he receives from someone else. Anyone else who receives retirement benefits through inheritance is going to end up having to use their own life expectancy, and not only that, but the implication of that is that the successor, whoever receives that after that person has passed away, will be also using, the original beneficiary's life expectancy. And so what that really entails or means is that if you leave it to a spouse and a spouse can roll it over, that spouse no longer is the beneficiary of the inherited account, but is now the owner and can therefore leave it to his or her grandchildren or anyone else and stretch out the retirement benefits for perhaps another 50 or 60 years. And given the importance of stretching out retirement benefits, it's important for two reasons. One, the longer you can stretch it out, the less you've had to take out the required distributions that you may not even need, but that a future generation may need. And secondly, it allows the continual building up of wealth within that account.
And you talked about how an inherited IRA works. That's the mechanics of that transaction. But what about an employer-sponsored plan? Can those be inherited and passed on as well? And how does that work?
Absolutely, absolutely. Upon termination of your employment, first of all, you can roll over your say 401k plan or 403b into your own IRA. The other thing is any workplace plan can be left to an heir.
So if you wanted to roll that over into your own IRA, you can't do that while you still work for the company if it's an employer-sponsored plan, right? You have to actually quit your job in order to get the money into your own account, right?
Correct. Although it depends on the specific plan. Some plans allow for an in-service distribution at age 62. Others don't allow it at all while you're still working. So it really depends. The plans can be all very unique to each other.
In other words, they need to get an expert like you that knows what the nuances are to figure it out, right?
Well, they really should, because there are so many unforgiving rules and so many nuances that have to do with these plans. Even the smallest mistake, or what appeared to be the smallest mistake, for example, if an IRA is left to someone but it doesn't go into a designated inheritance account, an inherited IRA, and let's say it ends up being transferred to that person's own account and he or she is not a spouse, that's an immediate distribution and that's fully taxable right then and there. So
what about
there
borrowing?
are a lot of implications. So.
I mean, you can borrow against pension plans, right? What are the rules about that?
Well, if your plan allows for it, you can usually borrow against your 401k or 403b. However, there are a lot of rules to that too. For example, you've got to pay the loan back in full before you terminate, or that could be considered an immediate distribution as well.
And are there limitations as to how much you can borrow?
It could depend on the plan.
Okay, rather than the IRS
plan.
So going back, to the complexity and why someone should engage someone like you, Michael, for your services, how do we end up with so many retirement plans? I get dizzy when I hear all the names of SEP and Keogh and this and that and
Top
Roth
heavy.
Well, yeah.
Age-weighted profit-sharing plans.
I actually had two friends on my Little League team named Sepp and Keogh, so that's how I got into the business. So. No, it is complex, and part of the reason is in the old days, almost I think 80 or 90% of Americans were covered by defined benefit pension plans. But through the years, those have been considered to be cost prohibitive for businesses, and they've offloaded the responsibility of having them. And so now we've come up with IRAs and Roths and all sorts of individual retirement accounts, and more people are probably self-employed than ever before as well. So
plus, people who write plans like this need job security of creating more and more instruments.
Well, it's just like the accountants with the tax code.
Yeah.
Okay, we're going to cut to our first commercial break. We're in the studio here with Mike Zabelin, who's given us some great information about retirement plans, pretty much all the kind of questions that all you listeners are interested in. And here is our first trivia question. Again, remember that the theme is Who Blew It? Who was the University of Michigan basketball player who blew it when he called a timeout when his team had none remaining in 1993, which cost his team the championship? Hint, he was part of the Fab Five. Now, not Fab Four like the Beatles, but part of the Fab Five. We will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host. I'm in the studio here with Mark Hanf of Pacific Private Money, Brian Burke of Praxis Capital, and our special guest, Mike Zabelin of Madrone Retirement Investors. And he's going to be talking more about retirement planning. And right after I give the question that we cut to commercial break with, who was the University of Michigan basketball player who blew it when he called a timeout when his team had none remaining in 1993, which cost his team the championship against North Carolina? And I'm looking at blank stares. Chris Webber. Oh, yeah, I remember him.
Yeah.
Played for the Warriors, and
can't
PJ
say
Carlesimo with the choking incident and all that.
I think that was Latrell Sprewell.
You're right. You're right, it was Latrell
That could have
Sprewell.
been another trivia question.
That's right. And remember, Latrell had said when he was offered a $100 million contract and he wanted more, he says, "Hey, man, I got to feed my family." Yeah, I like that one.
I remember that. That's
Mark,
great.
you wanted to lead in with a question.
Yeah. Michael, in 2010 there was a big deal made about an opportunity, and I guess it was a one-time opportunity in 2010 to convert your traditional pre-tax IRAs into what's called a Roth. I guess it's post-tax, or maybe there's a better explanation for that. But is there still a reason to do that today? And if so, what are some of the factors you would take into consideration in converting your traditional to a Roth IRA?
Sure. Well, what you're referring to, I think, is what happened in 2010
Yes.
when a one-time, the ability to roll over your Roth into an IRA, roll over your traditional IRA into a Roth,
Right.
allowed you to split the tax over 2011 and 2012. So that was a really special deal.
Yeah, I want to have my.
You want to do over?
Oh no, I want to flip it. I want to have my Roth go into my regular traditional IRA.
Well, let's take care of this one first.
Now that the audience is confused.
Yeah, but going after tax and making it something pre-tax.
Yes, Mark, that there are still a lot of good reasons to consider, not necessarily to do, but to consider rolling a traditional IRA into a Roth. So, the factors that, well, basically, so that everyone understands this, what happens is when you have a traditional IRA, you have money in an account that has not yet been taxed. The tax has been deferred. It's a deferred account. A Roth, on the other hand, consists typically of post-tax dollars. The tax has already been paid. And so when you have a traditional IRA, you more or less should probably assume something like about a third of that is going to go to the government when it's taxed. And it will be
upon distributions.
Upon distributions. Now, again, that could be higher or lower. It depends on your tax bracket.
Right.
It could be taxed as high as 50%, or it could be taxed as high as 70% if tax rates go up. We don't know. Or it could be low.
Or they might even come to a point where they start taxing it inside. I'm sort of predicting
your
that.
conspircy
I
theory.
know.
I know. You keep bringing that
There's a
up. every few
revenue
shows.
raise method there.
Well, there certainly could always be legislation passed on, quote, excess distributions over a certain amount, and that's, I think, happened before. But we don't know the future, and but the factors that usually go into this are, how many years will I have before I need to take money out of the Roth? The more years you have, the more that money is going tax-free or growing tax-free. So if you convert $10,000 from your traditional IRA, pay the tax on whatever it is, and you may not have to pay much tax if you didn't have much income this year, or if there are certain other factors that apply, or you may have to. The higher the tax that you pay now, the more years that you're going to want it to grow in the Roth to compensate for how much tax you've had to pay. So that's one factor. The other factor is, do you expect or have any reason to believe that your tax rates are going to be lower years from now, or higher? If they're going to be higher years from now, that's another reason to convert to a Roth now.
I suspect they might be higher.
Well, that's the common wisdom, but the common wisdom has often been wrong too. And so a good strategy is to keep money in all different accounts: traditional IRAs, Roths, and taxable accounts.
So you're recommending that your clients have both types of accounts: the traditional IRA that allows you to defer taxes on contributions, and then the Roth IRA, which you put in after-tax money, but it grows tax-free.
Well, you actually get a tax deduction for putting the money in the IRA, right? And it accumulates tax deferred,
Right,
so you
exactly.
get kind of that double benefit. The interesting thing here, though, and again, this is the conspiracy theory part of me, I think what the government, and please do not be listening to this show at the time I'm saying this, I think at some point what they're going to do is, if there's too many people putting money in Roth IRAs, they're going to look at that big bucket of cash and they're going to go, you know what, why don't we just start taxing that? Because remember, Social Security used to be off limits. Right? They didn't tax that before. I mean, how can you tax this after-tax money? Well, what's the difference?
Everything's on the table.
Everything is on the table. So
Yeah,
that's just
true.
my own personal thing about Roths.
Right. Well, all of those things are true. The other risk that people take when they do convert to a Roth is that they're now bearing the entire investment, the whole risk of it on their own. Whereas in a traditional IRA, if the government basically has a claim on about a third of it, if the account goes down, you haven't prepaid the tax on it. So that's something to consider as a factor. I mean, it's hard to know how investments will do over the years, but it's good to know that you're going to be bearing the risk of having prepaid the tax, and if the investments go down, it could turn out to not be a great deal. But given the long-term historical record of how investments have done, with a diversified portfolio of low-cost index funds, say, the returns over many, many years have been anywhere from 6 to 8%. Will that continue in the future? Nobody knows. But we all have to make some plans and use some assumptions.
Are most Roth IRAs self-directed? Because I hear a lot about self-directed Roth IRAs.
Well, the term, and Brian and I were talking about this before the show, the term self-directed from a legal standpoint, or the point from that has often been referred to originally, was simply an account that you had, an IRA that you had at, say, Schwab, that you picked the stocks and bonds yourself in, and that was what we refer to as self-directed.
Traditional self-directed.
Yeah.
If we want to really
A
confuse it.
traditional Roth self-directed.
And self-directed
Sorry,
applies to Roths and to regular IRAs, as well as to your to your 401k to some degree, because you have an investment menu and you can often
Right, you can choose
within that
stuff.
menu, unless you have a self-directed brokerage account. But nowadays, the term commonly is used when people say self-directed. They mean holding real estate or having an alternative investment
Well, yeah, because
besides stocks and
it's
bonds.
not self-administered. You have to have a third-party independent administrator.
Well,
That's
you know,
different.
well, in an IRA, you can never hold title to the assets. They always have to be held by a custodian
Yeah.
or so. And, that,
And there's a bunch of custodians I know, some of the largest in the country are based here in the Bay Area, and many of them will allow you, if you have an account with them, you can, as you said, buy real estate, or you can invest in real estate secured notes, you can do equity investments, you can do all
Well, we
kinds of
have
interesting things.
we have a lot of investors in the Praxis funds that are using self-directed IRA money, and I would suspect, Mark, you probably have some of your investors in private money loans that are also using self-directed IRA
Absolutely, you can
account
invest
money.
in what's called trust deed investments,
Right.
which is really a financing instrument. To,
So
make
this is
great
where we're
returns.
getting into real estate and alternative investments within
Yeah.
an IRA, and
Well-
that's what we call a self-directed IRA.
well, I actually have a question about that, and that is, with holding real estate in an IRA, obviously you have to make sure that the title is held properly.
Correct.
Yes.
But also, how do you handle the unrelated business taxable income from that?
Yeah,
Because
anything over $1,000.
over $1,000.
Or on leveraged real estate, if they own leveraged real estate within the portfolio, then they could be subject to that UBIT or UBTI, as it's sometimes called. And what we've found with some of our clients is they're going to be subject to that unrelated business income tax, but with the high returns that they're getting from making equity investments, they're netting more money even after paying that tax
So
than they would have otherwise.
investing in a, well, wait a minute though, people investing in your funds, are they going to actually be subject, their IRAs, to UBTI?
Yeah, they are in a lot of cases. If the property is leveraged, which in most cases property is typically leveraged, then they'll be subject to the tax. I'm not quite exactly clear on how this works. You almost have to be a tax attorney to figure it out. It's so complicated, but it's on the portion of the investment